It was March 2020. The stock market had just lost 34% of its value in 33 days. The fastest crash in American history. Portfolios that had taken decades to build were cut nearly in half in a single month. And here's what happened next. Millions of investors, not panicking amateurs, but experienced, educated people, sold everything. They watched the numbers falling, and they could not take it anymore. They hit sell. 3 weeks later, the market turned around and launched into one of the greatest bull runs in history. Those same investors who sold at the bottom, they locked in permanent losses and missed the entire recovery. This wasn't stupidity. These were smart people. People who knew intellectually that markets recover. People who had financial advisors, index funds, long-term plans. So what happened? Why did their knowledge fail them? The answer isn't found in spreadsheets or financial models. It is found in the human brain, and specifically in the way our ancient psychology was never designed to handle modern financial markets. Today, we're going to go deep into the psychology of panic selling. We'll look at the neuroscience of financial fear, the behavioral patterns that destroy wealth, and most importantly, the specific mental techniques that protect you when everything around you is falling apart. If you've ever sold during a downturn and regretted it, this video is for you. If you are worried you might do it in the next crash, because there will be a next crash, let's start at the beginning. To understand why panic selling happens, we have to go back roughly 200,000 years. Your brain, the one you are using right now, is largely the same brain that kept your ancestors alive on the African savanna. It is an extraordinary survival machine. It detects threats faster than conscious thought. It floods your body with adrenaline in milliseconds. It forces your attention onto danger and shuts down everything else. This system kept humans alive for hundreds of thousands of years. It is, without question, one of the greatest biological achievements in the history of life on Earth. It is also catastrophically bad at investing. Here is why. The threat detection system in your brain, centered in an almond-shaped structure called the amygdala, cannot tell the difference between a tiger and a falling stock price. It processes both as danger. It responds to both with the same ancient emergency protocol: get to safety. Right now, when you watch your portfolio drop 20%, 30%, 40%, your amygdala fires. Stress hormones flood your system. Your prefrontal cortex, the rational, long-term thinking part of your brain, gets partially overridden. You stop being a strategic investor and start being a frightened animal trying to escape. Neuroscientists call this amygdala hijack. Your emotional brain literally takes over decision making from your rational brain. And in that state, sell everything and get to safety feels like the only logical move. This is not a character flaw. This is biology. The same system that would save your life if a car was skidding toward you is the system that destroys your investment returns. But here is where it gets more complicated. It is not just fear driving panic selling. There is a second psychological force at work, one that researchers have called the single most powerful force in all of behavioral economics: loss aversion. In 1979, psychologists Daniel Kahneman and Amos Tversky published a landmark paper that would eventually win a Nobel Prize. They discovered something that seems simple but has profound implications. The pain of losing money is roughly twice as powerful as the pleasure of gaining the same amount. Read that again. Losing $1,000 hurts approximately twice as much as gaining $1,000 feels good. This means the math of investing is not how your brain experiences investing. You might be up 40% over 3 years, but a 15% drawdown in the last month will feel worse than all those gains felt good. You'll feel like you are losing even when you are still winning. This is why people sell after a 20% correction, even when they're still up 30% from where they started. The recent loss overwhelms. The accumulated gain, the pain of the present moment, eclipses the memory of the journey. Kahneman called our tendency to focus on recent events and weight them too heavily the availability heuristic. The most available memories, the most recent, the most vivid, the most emotionally charged, feel most representative of reality. A month of red candles feels more real than 3 years of growth, and the financial media knows this. Every network, every financial news app, every market data provider has learned that fear drives engagement more than confidence. Falling markets generate more clicks, more views, more advertising revenue than rising markets. So the coverage of downturns is always louder, more dramatic, more apocalyptic than the coverage of recoveries. Your brain is receiving a continuous signal: danger, danger, and your amygdala has no reason to doubt it. There is one more layer to this psychological trap: social proof. When the market drops, you look around. Your neighbor is selling, your coworker is selling. Finance Twitter is screaming that the bottom hasn't been reached yet. The herd is moving toward the exit. We are social creatures. We survive by following the tribe. And when the tribe is running, the instinct to run with them is almost irresistible. Psychologists call this herding behavior, and in financial markets, it is how crashes turn into catastrophes. Everyone waits for someone else to panic first, and then everyone panics together. The individual investor sitting at home watching the portfolio turn red is fighting against 200,000 years of evolution, a psychological bias discovered by a Nobel Prize winner, and the deliberate fear-mongering of a trillion-dollar media industry. No wonder so many smart people sell at the bottom. Before we talk about solutions, we need to fully confront the cost, because one of the reasons people don't take panic selling seriously is that it feels survivable. You sell, the market keeps falling, you feel vindicated. Then the market recovers, you buy back in, and you tell yourself you broke even. But the math almost never works out that way. Let's walk through exactly what panic selling costs you, and the numbers are going to be uncomfortable. The first cost is the obvious one: selling at a loss. If you invested $100,000 and the market drops 30%, your portfolio is worth $70,000. If you sell, you've locked in that $30,000 loss. It is no longer a paper loss. It is real. But the second cost is where the real damage happens. Missing the recovery here is a fact that almost nobody internalizes. The best trading days in the stock market are almost always clustered immediately after the worst trading days. The market crashes, hits bottom, and then often within days or weeks, it snaps back violently. If you are sitting in cash because you panicked out of the market, you miss those days, and missing just a handful of the best days in a given decade is catastrophic for your returns. JP Morgan Asset Management has studied this extensively. An investor who stayed fully invested in the S&P 500 from 2003 to 2022 earned an annualized return of around 9.8%. An investor who missed just the 10 best days in that 20-year period earned 5.6%. Missing the 20 best days dropped returns to 2%. Missing the 30 best days produced negative real returns 10 days. Out of more than 5,000 trading days, that is all it takes to cut your wealth in half. And those days are almost impossible to predict. They happen during the chaos of recoveries, not during calm, rising markets. To capture them, you have to be invested during the storm. Now let's make this personal. Let's say two investors both started with $100,000 in January 2020, right before the COVID crash. We'll call them Alex and Jordan. Alex watched the crash happen and stayed invested. Portfolio dropped to roughly $66,000 at the March bottom. Uncomfortable, stressful. But Alex held. Jordan watched the same crash and panicked. Sold in late March at the bottom, moved everything to cash, waited for things to calm down. By year-end 2020, the S&P 500 had recovered and was up about 18% from January. Alex's $100,000 was worth around $118,000. Jordan was sitting in cash, had bought back in at higher prices in the summer when things seemed safer, and was roughly at break, even before accounting for inflation or the opportunity cost of being in cash for months. Over a decade, that difference compounds. Alex's $118,000 grows. Jordan is starting over from $100,000, or worse, from less if they bought back at higher prices. But the cost isn't just financial. There is a psychological cost that researchers have only recently started quantifying. Investors who panic sell once are significantly more likely to do it again. The behavior reinforces itself. The brain learns. When I feel this fear, I sell and I feel better. It becomes a pattern, a habit. Each market downturn triggers the same response, and each response makes it more ingrained. Meanwhile, investors who resist panic selling once, who hold through their first major drawdown and see the recovery, build a different kind of immunity. They have first-hand evidence that the fear was survivable. Their brain has a new data point to draw on next time. The most dangerous investor, psychologically, is someone who has only ever invested during a bull market. They have no reference experience for what a crash feels like, when it happens, and it will happen. They have nothing to anchor to. No memory of having survived it before. This is one of the hidden gifts of investing through 2000, 2008, and 2020. The investors who held through those crashes and came out the other side carry something no bull market can give you. The lived knowledge that you can survive a 40% drawdown, that the world doesn't end, that markets recover. There is another cost of panic selling that almost nobody talks about: the tax consequences in a taxable account. When you sell appreciated assets at a loss, you can use those losses to offset gains. That is actually a legitimate strategy called tax loss harvesting when done with intention. But panic selling is different. It is reactive, not strategic. Often, panic sellers sell assets they've held for various time periods, generating short-term capital gains tax obligations at the worst possible moment, right when they've just locked in a loss. And when they buy back in later at higher prices, they've now reset their cost basis upward, meaning the eventual gains, when markets fully recover, will generate larger tax bills. The tax drag compounds over years. A disciplined buy and hold investor in a tax-advantaged account can dramatically outperform an active panic seller, not just through better market timing, but through simple tax efficiency. The full cost of panic selling includes the locked-in loss, the missed recovery gains, the behavioral reinforcement of a destructive pattern, and the tax consequences of reactive trading. In aggregate, over a lifetime of investing, the average habitual panic seller may underperform the simple index fund holder by millions of dollars. Not because they're unintelligent, not because they don't understand markets, but because their psychology isn't managed. Let's slow down and trace exactly what happens inside a panic seller's mind during a market crash, because understanding the loop is the first step to breaking it. Stage 1, the trigger. The market drops. Maybe it is a bad inflation report, a war breaking out, a bank failure, an earnings miss from a major company. The drop might be 2%, 5%, 10%. Your portfolio goes red. The financial news coverage becomes intense. Your phone buzzes with alerts. This is the moment the psychological machinery starts turning. Stage 2, threat detection. Your amygdala registers the financial loss as a threat signal. This happens below the level of conscious thought. You feel it before you think it. A tightening in the chest, a restless, anxious energy, difficulty concentrating on other things. Your nervous system is now in a mild state of alert. Stage 3, information seeking. You start checking prices more frequently. You read the news coverage, looking for reassurance. But the news coverage is designed to hold your attention through fear, not reassure you. Every article you read makes the situation seem more dire. You check Reddit, financial Twitter, investment forums. You find people who are more panicked than you, and their panic feeds yours. Stage 4, mental narrative formation. Your brain, trying to make sense of the chaos, starts constructing a story. This time, it is different. The fundamentals are broken. The market is going to keep falling. This narrative isn't based on evidence. It is constructed from fear, from the most recent available memories, from the loudest voices in the most recent news cycle. But it feels absolutely convincing. Stage 5, the trigger point. The loss hits some psychological threshold, 10%, 15%, 20%, that your brain has decided somewhere is the "this is too much" number. The rational mind is still there, still knows intellectually that markets recover, still remembers the long-term plan. But the emotional brain is now so flooded with stress response that rational thought can barely get through. Stage 6, the sell. You execute the trade. And here is the crucial thing that happens immediately after relief, pure, immediate neurochemical relief. The threat is neutralized, the anxiety drops, your nervous system returns to baseline. Your brain registers this as selling equals good. Stage 7, rationalization. Now your rational brain, which was overridden during the decision, comes back online and constructs a justification. I sold at a good time. I am going to buy back at lower prices. I am protecting my capital. These feel like rational reasons. They are actually post hoc stories invented to explain a decision made entirely on emotional grounds. Stage 8. The wait. You sit in cash. You watch the market for a while. If the market keeps falling, you feel vindicated. This is dangerous. Your brain is reinforcing the pattern even more strongly. Stage 9. Eventually, you need to get back in, but now you face a new psychological trap, anchoring. You know what price you sold at. That price feels like a reference point. You are waiting for prices to fall below that number so you can buy back cheaper. But if the market recovers first, which it often does, faster than expected, you face a choice between buying back at higher prices than you sold, humiliating to the brain, or staying in cash, comfortable but costly. Most panic sellers re-enter too late. They buy back in after the recovery is well underway, near the new highs, just in time for the next correction. And the loop begins again. This is the behavioral poverty trap of financial psychology. Not a lack of money, but a loop of reactive behavior that prevents wealth accumulation no matter how good the market is. Understanding this loop is not just intellectually interesting. It is financially life-changing. Because once you can see the loop clearly, can name each stage as you are experiencing it, you gain the ability to intervene. Now we get to the part that matters most. Not just understanding why panic selling happens, but understanding what actually prevents it. The good news is that behavioral finance researchers haven't just documented these problems. They've also studied what distinguishes investors who hold through downturns from those who don't. And the patterns are clear. The first and most powerful protection against panic selling is what researchers call a pre-commitment strategy. This means making decisions in advance, before the crash, before the fear, before the amygdala takes over, and building structures that make it difficult to act on impulse during the storm. The most elegant version of this is the investment policy statement. Professional investors and institutional funds all operate with written policy documents that define exactly what they will and won't do under various market conditions. They specify asset allocation, they specify rebalancing triggers, they specify explicitly, under no circumstances will we liquidate equity holdings due to short-term market movements. When the crash comes and the board starts panicking, the portfolio manager points to the document. We agreed to this in advance. When we were calm and rational and strategic, we made these rules. We follow the rules. Individual investors can do the same thing. Write down in advance your investment philosophy, your time horizon, your response to a 20% drawdown, which is to buy more, not sell. Your response to a 40% drawdown, which is to buy as much as you possibly can. Sign it, date it, show it to someone you trust. The act of writing this in advance does two things. First, it engages your prefrontal cortex, your rational brain, in creating a plan during a calm, rational state. Second, it gives you an anchor during the storm. When the crash comes and every instinct is screaming to sell, you can reread what your calm self wrote. You can remember who you are as an investor when fear isn't running the show. The second protection is what psychologists call systematic desensitization, and for investors, it happens through education and mental rehearsal. Fear is most overwhelming when it is unfamiliar. If you've never experienced a 30% market decline, the first one is genuinely terrifying. There is no reference experience, no proof that you can survive it. But if you've deeply studied previous market crashes, if you know in vivid detail what happened in 1929, 1987, 2000, 2008, 2020, you have a cognitive framework for what a crash feels like and what comes after. You've mentally rehearsed the experience. You have a map. This is why studying market history isn't just academically interesting. It is psychologically protective. Every major crash in history has been followed by a recovery. Every single one, knowing this in your bones, not just in your head, changes how you respond when the next one happens. Mental rehearsal takes this further. Imagine now, in a calm moment, what you will feel when your portfolio is down 30%. Visualize the news coverage, visualize your portfolio screen, feel the anxiety, and then visualize yourself checking your investment policy statement. Visualize yourself doing nothing. Visualize the recovery. This sounds abstract, but the neuroscience supports it. Mental rehearsal activates many of the same neural pathways as the actual experience. Athletes use it to perform under pressure. Surgeons use it before complex procedures. Investors can use it to build psychological resilience before the next crash. The third protection is portfolio structure. Not all portfolios create the same psychological pressure. If you are invested in a single stock, a 30% decline means something catastrophic might be happening to that company. Maybe it is. The fear is not irrational. If you are invested in a diversified index fund, a 30% decline means the entire market has declined. And in the entire 150-year history of modern financial markets, the market has always recovered from that. Diversification isn't just financial risk management. It is psychological risk management. You are not betting on any single company's survival. You are betting on the collective survival of the economic system, which has a 100% track record. The fourth protection is automation. The hardest thing to do during a market crash is to buy more. It requires active, deliberate action against every emotional instinct. But automated investments, scheduled contributions to your portfolio on a fixed calendar, regardless of market conditions, turn that active decision into a passive habit. Dollar cost averaging through a market decline is one of the most powerful wealth-building behaviors available to retail investors. You are buying shares at lower and lower prices as the market falls. When the recovery happens, those discounted shares generate outsized returns. But most people can't bring themselves to execute this actively when their portfolio is bleeding. Automation removes the emotional friction. Set up automatic monthly investments. Don't check your portfolio more than once a month during normal times. Don't check it more than once a week during a crash. Reduce the frequency of information exposure, and you reduce the frequency of amygdala activation. The fifth protection is what I'd call the investor identity shift. Most people see themselves as people who happen to own investments. The investments are external to their identity. When the investments fall, they feel loss. They've lost something that was separate from them. The investors who are most psychologically resilient see themselves as long-term wealth builders. The identity is internal. A temporary market decline doesn't change who they are. It doesn't change their philosophy, their strategy, or their trajectory. This identity shift sounds soft and motivational, but it has concrete behavioral effects. When a 20% decline hits, the wealth builder identity says, "This is a feature, not a bug. I buy more here." This is where generational wealth gets built. The investor who simply owns some stock says, "I am losing money. I need to make it stop." Identity determines behavior under pressure. The sixth protection is social accountability. Find one other person, a spouse, a friend, a financial community, who shares your investment philosophy and knows your plan. During a crash, talk to that person before making any major portfolio decision. Out loud, explain what you are thinking of doing and why. This process, called self-distancing by psychologists, does something remarkable. When you have to explain your thinking to another person, you are forced to translate emotional impulses into rational language. And in that translation, you often hear yourself saying things that don't quite make sense. "I want to sell everything because the market has fallen 20%, and I am scared" sounds different when you say it out loud to someone who knows your 15-year investment plan. The accountability conversation is not about being talked out of selling by a cheerleader. It is about creating a mandatory pause between emotional impulse and consequential action. Let's get concrete. Let's look at what the investors who have consistently built wealth actually do during market crashes. Warren Buffett has held Berkshire Hathaway through multiple crashes that saw the stock drop 40%, 50%, even more when asked how he handles downturns. His answer is almost frustratingly simple. He doesn't see a market price decline as a loss, he sees it as a sale. The business he owns is worth the same amount it was worth yesterday. The price the market is offering him for it today is just lower. And lower prices are good news for buyers. This reframe from "my portfolio is losing value" to "assets I want to own are going on sale" is not natural. It runs directly against the loss aversion wiring of the human brain, but it can be trained. Every time you catch yourself thinking, "My portfolio is down X%, consciously reframe it. "Assets I intend to own for 15 years are available at a X% discount." Do this enough times, and it begins to change how crashes feel. Peter Lynch, who ran the Magellan Fund from 1977 to 1990 and generated 29% annualized returns, talked about the importance of the stomach in investing, not the brain, the stomach. The ability to endure discomfort, to tolerate uncertainty, to sit with fear without acting on it. This is the core skill of long-term investing. It is learnable, but it requires practice, just like any physical skill. Lynch also made a point that seems obvious until you really sit with it. The people who make the most money in the market are not the ones who bought at the bottom. They're the ones who stayed in, because no one buys at the bottom. No one rings a bell. The bottom is only visible in hindsight. The investors who outperform over decades are the ones who are simply always invested through the corrections, the recessions, the crashes, the panics. They're boring, they're consistent, they're relentless. John Bogle, the founder of Vanguard and the inventor of the index fund, put it as plainly as possible. The stock market is a giant distraction to the business of investing. The market price is noise. The underlying businesses, the companies generating real revenue, producing real products, employing real people, don't stop existing because the stock price fell. The market will eventually catch up to reality. It always has. These investors, Buffett, Lynch, Bogle, are not superhuman. They're not devoid of fear. What they have is a framework that is stronger than the fear, a philosophy that holds when psychology would fail, a structure that makes panic selling not just undesirable, but conceptually impossible. And that framework is available to any investor willing to build it. Let me give you a concrete, actionable plan. This is what to do right now, before the next crash, and what to do when it comes. Before the next crash, step 1, write your investment policy statement, 1 page, your time horizon, your target asset allocation. A statement that during any market decline greater than 10%, you will not sell equity holdings. A statement that during any market decline greater than 20%, you will increase contributions, sign it, date it. Step 2, study the crashes, not just the graphs. The full history. What people were saying in March 2009 when the market was at its bottom, what the media headlines looked like, how convinced everyone was that it was going to zero. Then study what happened in the 12 months after. Let that history become part of your emotional knowledge, not just your intellectual knowledge. Step 3, automate your investments. Monthly contributions, automatic, regardless of market conditions. Set it up today. Remove the active decision from the equation. Step 4, reduce your portfolio, checking frequency. During normal markets, once a month. During downturns, once a week maximum. Every time you check your portfolio, you are giving your amygdala a chance to activate. Reduce the exposure. Step 5, find one accountability partner. Someone who knows your plan and whom you'll contact before making any major portfolio change during a downturn. When the crash comes, first 24 hours, do nothing. This is the rule. Whatever the impulse is, do nothing for 24 hours. Give your nervous system time to return to baseline. Give your prefrontal cortex time to come back online. After 24 hours, reread your investment policy statement. Remind yourself who you are as an investor. Remind yourself what you decided when you were calm. After rereading, ask yourself one question. Has the fundamental long-term case for owning diversified equities changed? Not has the market fallen. Not is the news scary. Has the 150-year case for equity ownership as wealth building changed? In almost every scenario, the answer is no. A pandemic, a war, an inflation spike, a banking crisis, these are serious events. But they don't change the fact that over long time periods, productive companies create value and shareholders of those companies accumulate wealth. If your answer is still no, the fundamental case hasn't changed, then you hold, you buy more if you can, and you wait. The stock market is one of the most powerful wealth-building tools ever created. Over long time periods, it has reliably converted patience into prosperity. But it doesn't give that prosperity to everyone who invests. It gives it to the ones who can hold. Panic selling is the tax that volatility collects from investors who haven't done the psychological work, and it is the biggest, most avoidable tax in all of personal finance. The crash will come, it always does. What you do when it arrives, Whether you are controlled by the ancient fear your brain was built to feel, or whether you are guided by the rational philosophy you built in advance, will determine more about your financial future than almost any other single decision you make. You cannot control the market. You cannot predict the bottom. You cannot know when the recovery starts. What you can control is your response. And that is everything. If this video helped you think differently about your investing psychology, subscribe to Bull Market. We go deep on the mental side of building wealth every week, and share this with anyone you know who has been burned by panic selling before. We'll see you next time.